Welcome to the Deep Dive. We're looking at the global real estate perspective using fresh data from November 2025. Our mission today is pretty simple, to unpack where capital is flowing globally and maybe more importantly, why.
And right away, the thing that jumps out is what the market is actually worried about. It's not trade wars anymore. The new anxiety is all about fiscal sustainability, and that's pushed global bond yields up.
Right, which you'd think would put a chill on things, but the market is showing this incredible resilience.
It really is, and it's not just a feeling. It's showing up in the actual money moving around.
Exactly. Direct investment confidence seems to be back in a big way. Global transaction volumes just in Q3 hit $213 billion. That's a 17% jump from last year.
Which is huge.
Mm-hmm.
And you have to look at where that's coming from. There's a real divergence.
You mean regionally?
Yeah, the Americas, and really specifically the U.S., are just running away with it. They posted a massive 26% rise. So the question becomes, what's making the U.S. such a magnet compared to, say, Europe or APAC?
I think that's the key question. It suggests capital is just prioritizing stability and scale above all else right now. Okay, so let's drill down into the sectors because the office market is, well, it's a fascinating paradox.
It really is. On one hand, global office leasing for the first 9 months of the year. It's the highest it's been since 2019.
Before everything changed.
Exactly. But that demand is running headfirst into a major supply crunch.
A crunch is putting it lightly. U.S. groundbreaking, so new construction, have fallen to a record low, and the global vacancy rate actually fell.
So what that means is you've got more people chasing fewer high-quality buildings. The competition for that top-tier sustainable space is getting, incredibly intense.
It's a fight for scarce, quality assets. Now, speaking of big sectors, let's talk about the living sector. A lot of people see this as the future giant.
Oh, absolutely.
Yeah.
And investment volumes are finally on track to hit those pre-COVID averages this year, which is a big milestone. It's led by the U.S., but also by this really strong demand for purpose-built student accommodation, PBSA.
And if you connect that to the bigger picture, it's pretty clear. We have sustained housing shortages pretty much everywhere. This sector is going to be a focus for huge capital for decades.
No question.
Okay, let's do a quick run through the other commercial segments. What's the story with logistics?
Sentiment there is definitely improving. You've got pent-up demand returning. But the critical thing is that new supply is forecast to drop off a cliff through 2026.
So that sets up for a major tightening in the market.
Major tightening, yeah, especially North America and Europe.
And retail. I feel like we've been talking about its challenges for years.
Well, it's proving resilient, but you have to think of it as a multi-speed market. It's really being driven by higher-income consumers. But the key indicator for health is that U.S. store openings are now actually outpacing closures.
Interesting. So retailers are getting smarter about their footprints. And finally, hotels.
Performance is, let's say, normalizing. The huge boom we saw in 22 and 23 is settling down. Right now, Europe is actually leading the growth in RevPAR, that's revenue per available room.
Which tells us people are still prioritizing experiences.
Absolutely.
Yeah.
And that's the long-term trend. You see hotel brands expanding into new things, like lifestyle hotels, just to capture that slice of consumer spending.
So when we put this all together, what does it mean for you? I think the synthesis shows a clear return of confidence.
It does. Capital is flowing again,
Right.
and it's overlooking higher bond yields because the property fundamentals are strong. In almost every prime sector, offices, living, logistics demand is now seriously outstripping supply.
It's a market that's fundamentally prioritizing quality and experience over everything else.
That's the perfect way to put it. The best offices are leasing up, the living sector is growing because of a structural undersupply, and even hotels are diversifying to meet that demand for experiences.
Which raises, I think, a really important question for the future. If all the capital is flowing toward these premium, resilient, experience-based assets, are we entering a period where second-tier real estate just fails to clear the market? Are we seeing a massive global quality bifurcation? That's something to consider as you map out strategy.